Financial Focus Radio Show is online all the time via iTunes, Spotify, and Spreaker. Catch past shows online or by downloading the Financial Focus app.
Welcome back to Financial Focus Radio. Thanks so much for joining us. My name is Tyler Simones. That is Josh Fenili. We're partners at Northwest Quadrant Wealth Management here in the beautiful Pacific Northwest. We appreciate you spending some time with us this weekend. This comes from the CARES Act. The extra $600 per week of federally funded unemployment benefits that was provided on March 27th under the CARES Act runs out today, actually, 7/25, or tomorrow, depending on where you live. State-funded jobless benefits continue for at least 30 weeks in 46 of the 50 states. So obviously that is something that the government is really grappling with, knowing that it is needed, some version of it is needed to be extended because of the ultimately really high level of unemployment. I think what the government is trying to grapple with is one of the unintended consequences of this extra $600 was that literally people were making more money being on unemployment than they were when they were employed. So when the economy did open back up in a lot of places, it was very difficult for employers to get their employees to come back. They said, well, I can sit on the couch and play video games and eat Cheetos, and I make more money doing that than busting my butt at your restaurant or your store or whatever it is. And so I think the government's trying to find some happy medium number that will reward people to go back to work, but the people that can't find work, they still have enough money.
Well, and there's been a substantial degree of infighting just between the administration and Senate Republicans, and it sounds, it got postponed. So whether or not they get a deal done before the end of July is
it's not happening by the time these things run out. But I think they'll have some.
But word is it's $400 that they've settled on. So
right.
I think that is the inflection point where maybe a lot of people will actually go back to work.
Let's hope. Because it's per week. So if you think about that on a monthly basis, it's a big, big number. So one of the things, Josh shared this with me, came from Institutional Investor. One of the things that bums me out and boggles my mind, and I know why this happens because I worked for mutual fund companies before I started doing this, but the Arkansas Teachers Retirement System is suing Allianz, which is a giant French insurance company, but they also manage a big asset management company here in the U.S. For allegedly losing $774 million of the pension money in their volatility trading fund. So what bums me out about this isn't necessarily Allianz. It's the darn board and the investment committee on these pension funds. So in the last segment, we talked about these alternative assets and alternative asset managers. And pension funds across the country, endowments, but these teacher pension funds, they're directed by, some of them are teachers, and then they have investment committees, and they move a big chunk of their money into these alternative assets, trying to generate either higher returns or lower correlated returns, all those sort of things we talked about in the last segment. But ironically, they're doing their $774 million is a ton of money to lose and really hard to replace. And what boggles my mind is if you just look at a asset allocation of indexes over time, it thumps the performance of these alternative assets.
Well, in a time when the argument for simplicity is growing stronger and stronger, they continue to do the absolutely contrary thing and double down on complexity.
And what's happening is the asset, these asset managers are very polished people. They have good salespeople, and they go to these pension funds and they take them to lunch, or they take them golfing, or they take them to do something, and that wins their investment dollars. You would think that these people would be just looking at the numbers and be basing it on empirical data, and would have a very easy job of ignoring the noise. Because believe me, we manage a decent amount of money at our firm, and so we get solicited on a daily basis and an hourly basis by all of these different firms, and their pitches are laughable to me because they cannot – there's nothing that they can say or show me that is going to contradict the long-term data of owning high-quality, low-cost index funds. The data is the data, and it's irrefutable. And so any sales pitch or lunch that they're going to bring me, or high-polished salesperson they're going to bring into our office, can't change the data. There's nothing they can say or do that's going to change the data. Yet these endowments allow them to. And so, they shouldn't be suing Allianz. The teachers should be suing the board and the committee, the fiduciaries that are actually making these stupid decisions of putting their money in these funds they have no business putting their money in. And, it happens over and over. Whether it's Harvard or you name the endowment or the pension, it's happening across the board. The only one that's done it successfully over time is David Swenson at Yale, but his outperformance and his advantage has come way, way down as more money's doing the same thing.
And he was the first mover, which is why the particular reason he enjoyed the advantage is because he moved first. And now they're all – the notion that institutional money is smart is kind of –
laughable.
Yeah, it's a joke because they're all rushing into an asset class that illiquidity premium is now eroded because everyone's doing it.
Well, and it can't absorb that much money either.
It really can't. And so it's just too much money chasing too few ideas, and it doesn't end well.
Yeah, so – all right, let's talk about the indexes as we were touting them a second ago. But the Nasdaq 100, so the Nasdaq is generally a tech-laden index that is 100 stocks weighted by market cap, meaning the bigger you are, the more influence you have on the market. So Apple represents 12% of the Nasdaq 100 from a influence. That's how much it influences the index. Microsoft 11.3, Amazon 11.2, Facebook 4.2, Alphabet is 7.2, and Tesla is 2.7. I'm sorry I'm laughing because it's such a laughable idea. And then all the other companies in the index represent 51%. So 1, 2, 3, 4, 5, 6 companies represent half of the index or the performance of the index. So that's on an index we think people should be buying. We don't have it in client portfolios because it's obviously a very concentrated index. But it's also true right now, the S&P. It's true of a lot of indexes. And if you're just buying the S&P, which is not something we would recommend, then you are very highly concentrated. And a lot of you out there, because you follow what Jack Bogle did at Vanguard or the Bogle heads, or you say, they say, oh, you just have to own the Vanguard Total Market or the Vanguard S&P 500 index. And we would say to you that while we wholeheartedly believe in indexing, you can't just own one index being the S&P or the Nasdaq. You need to own a diversified portfolio and use index funds. And so one of the things that we look at is, of course, we want to have large cap exposure. But if we have large cap exposure, we're so over allocated to just a few names that we have a lot of danger in our portfolio. The last time this happened was the late 90s, and it didn't end very well for those people. So what do you do? Well, what you do is you diversify in indexes down the market cap spectrum. So you look at small cap stocks, as a healthier allocation they have been for a lot of you. Look at mid-cap stocks, look at developed international stocks, look at different parts of the market that don't have such huge concentration and on a relative value are relatively attractive from a valuation standpoint relative to these indexes that are so highly concentrated. So the last time we were in this position, small cap dramatically outperform large cap, and so did developed international. There's no reason to believe that that's not going to happen here, and it's why we have allocated so much of our client money in that in those parts of the market.
Yeah, even 36% now in information technology and communication services.
Yeah, so we still believe in indexing, just own different indexes across the market cap. All right, when we come back, we're going to talk people that have estate plans have left some things out of there, so we're going to add a little bit of color around your estate plan. If you want to be part of the show, 877-670-7117.